Hello and welcome to the August 2023 issue of the Zavitz and Sykora Financial Strategies video newsletter. Thank you for tuning in and listening to our monthly update. I'm your advisor, Greg Sykora, presenting to you solo today. I'm going to quickly go over what's happened regarding portfolio performance in the past month, how much cash U.S. consumers have on the sidelines, and I'm also going to cover how are we being price gouged by corporations. And the final thing I'm going to talk about is funding related to Donald Trump's political campaign and some information I found in a BBC article I thought was interesting. This will be a real quick update. It'll be a simple update that I hope you all enjoy. So let's talk about performance. Over the past month, the very conservative, the conservative, the moderate growth, and the growth portfolios, they've all given back 1 to 2% of performance, mostly on the backs of strong unemployment data coming out and job creation data coming out of the US. Canada, not so much, but nonetheless, it has jolted equity markets and bond markets. So yields in the bond market have actually gone back up. They're near their all-time highs, not quite there, but their all-time highs were made in June of last year. So that's hurt bond prices. And then stocks retraced some of their gains. They were down 3 to 4%, 5%, depending on the index you're looking at over the course of the month. So all in all, as a reminder, the very conservative portfolio is around 20 to 30% stocks, 70 to 80% fixed income bonds. The conservative portfolio is around 45 to 50% stocks, 50 to 55% bonds. The moderate portfolio is around 60 to 70% stocks with around 30 to 40% bonds. And the growth portfolio is 80 to 85% stocks, 20 to 25% bonds. So what's news regarding cash balances and cash on hand for the US consumer? Well, this time last year, Mark and I were talking to you about why we had so much inflation. And it was a combination of pent-up demand and excess pandemic savings created by global supply demand imbalances. And this was really what was stoking central bankers and the inflation fire to keep fighting inflation to this day. So this is a chart showing that pandemic savings, I think savings account balances in the US are almost back to pre-pandemic levels. And it breaks it down into to different quartile earners, but unanimously across the board, high income earners all the way down to low income earners, the amount of savings they have on hand is basically back to where it was in 2019. And so given the big run up in prices from inflation that's happened over the past 2 to 3 years, and all the other pressures that are out there, I think we are on the cusp of inflation falling off further in the next few months. We've already come down to around a 3% level. It was just under 3% in June. It edged back up to around 3.2, 3.3% in Canada and the United States in the month of July. But I think there's a very high probability chance we start getting closer to around a 2.5% level by the end of the year. So that means all you conservative clients with conservative portfolios that consist of a lot of bonds, there's another catalyst that's going to be working in your favor. So not only are these bonds yielding a bit more, but the existing bonds, which had a tough year last year as yields went up, bond prices went down. Well, as inflation falls and interest rates fall, the inverse is going to happen. The bonds in your portfolio will start going up in price. I thought this was going to happen sooner, but now that we have less savings, I bet it's going to start happening at the end of this year, especially as weaker economic data continues to come out. So what about price gouging? Well, myself, and I think many Canadians out there, bought into the idea that corporations in Canada were marking up prices to take advantage of consumers. And we were big contributors, and they were big contributors to our inflation problem. Well, the Bank of Canada released in early August a special report exonerating private companies from fanning the inflation fire. Bank tracked both inflation markups, the ratio of a company's prices to its costs, comparing the average growth rate of a markup for private companies to the consumer price index inflation from the beginning of 2018 all the way to the end of 2022. So for about a year, you can see in here from 2020 to 2021, it looks like companies during the pandemic, it looks like they were gouging us to an extent. But counter to what many of us think or thought, markups actually went down afterwards in 2022 all the way into the beginning of 2023. I guess, so there we have it. We're not being price gouged, contrary to what the hive mind out there thinks. Markups by companies account for less than 1/10 of the inflation we see over this period. So, I mean, all this outrage against Galen Weston Jr., I mean, I really feel bad for the guy. And finally, I did mention Donald Trump political funding, and not to bring politics, into a financial review video, but I just couldn't resist this one, and it's about money anyway. So, I rolled my eyes. I couldn't help but think that this is a testament to the craziness of U.S. politics unfolding in front of us. According to this study published in early August, Trump's campaign funding actually increased since the indictment announcements against him. I think it's because when bad news comes off, like I think his team fires off email blasts to his supporters asking for money. And, that's because 30% of the US believes he's being targeted for political reasons. And so we have his supporters sending Donald Trump, a self-proclaimed billionaire, I don't know if he actually is a billionaire, funding, which he's also said in those emails he now plans to use to cover his legal fees. So you got the masses funding a billionaire's legal fees for potential crimes he's committed. I never thought I'd see the day, but alas, here we are. And that's it. Thank you for listening to the update. Next month, I will be talking to you about GICs, comparing them to investing in a stock and bond portfolio like the portfolio that you're in today, and why I think the stock and bond portfolio, although it's not guaranteed, is a better investment than investing in a GIC in today's rate environment, despite 5% being the offered rate by banks and credit unions. Thank you so much for listening to the update. I hope you have a great month ahead. Cheers.